that's ultimately why anyone would invest in the first place. It's not a question of if you should, it's a statement that you're going to need to. Welcome back to Invested in You, brought to you by Community First Investment Group. We're here to help you take the next step in your financial journey, no matter where you're starting from. Whether you're building your future, planning for retirement, or looking for more resources, we're here for your now and here for your future. I'm your host, Nate Hasto, and if you missed our pilot episode, we introduced our team, laid out what to expect this season, and gave a peek behind the curtain as why we do what we do. If you missed it, be sure to check it out to get to know our team a little bit better. Today we're starting with the basics, intro to investing. Whether you've never invested a dime or just want a clearer picture of how it all works, this episode's for you. We want to start with discussing a little bit about the power of investing. And simply put, it really can all be boiled down to compound interest. For those who are not familiar with the concept, compound interest is simply the ability for you to earn interest on your interest. You can indeed do that in a bank account. The aspect of investing that really supercharges this is the types of returns that you may be able to see from an investing account versus a bank account. So let's talk a little bit about what investing is first. Simply put, it's the action of spending money with the expectation of a profit or a return. I've been doing this for years at this point, and I've yet to meet someone who's asked me to have their investment account worth less in the future than it is today. So I think suffice to say, most people get the idea of what they're investing for. They want to see growth in the long term. So the big question is, why should people invest? If we boil this down, I think the reality is that you can never truly save your way to a fruitful retirement. And this is what I mean by that. If you consider average lifetime earnings of the average American, typically that's going to fall somewhere in the range of $1.1 to $1.7 million of lifetime earning. If we take somewhere in the middle of 1.5 as our average here, considering that you're not going to be working your entire life, let's say you start working at 18, right, and you plan on living a normal life expectancies to, let's say, mid-80s. If you need about 40 grand a year to get by, which is what the averages say, that's $2.7 million of lifetime expenses that come into play here. You can start to do the math. 1.5 million of average lifetime earning, 2.7 million of lifetime spending. And this is just 18 to 86. So if you live longer, it's an even bigger number there. You truly need to have the ability to generate more money than you'll ever be able to save or put away for yourself. So to kind of go into the math a little bit further here, if we took the average, let's say, of say 30 grand a year for an average salary, which again, I think is probably pretty conservative. And if we decided at 18, we're going to invest 10% of that. That's $3,000 per year, or $250 per month. Assuming you were able to invest, and assuming you were able to get an 8% return, which is not guaranteed, but it's a fair number for us to use as a hypothetical, what that would actually produce $2 million by the time you're ready to retire. So realistically speaking, that's ultimately why anyone would invest in the first place. It's not a question of if you should, it's a statement that you're going to need to. Investing is one of the key factors of being able to truly have flexibility and options in retirement. There are numerous ways that you can go about investing. So we'll break down a little bit on the key investment vehicles that you may choose to begin our session here. The first and most common that people think of are stocks. Simply put, these are part ownership in a corporation or a company. These may be very large publicly traded companies. They may be privately held companies. But most people are familiar with the publicly traded ones like your Apple, Amazon, Google, NVIDIA. And there are certainly thousands and thousands of others to invest in besides those companies. You have bonds, which is usually where people's attention starts to dissipate after we get past stocks. Bonds are interesting in the sense that it's a bit of a juxtaposition of what many of us have done several times in our life. Most of us have taken out a loan at some point. And a bond is also a loan, but you're playing the role of the bank in this case. So it is an IOU, it is a loan. You are lending money to either a government, if it's a government bond, to a corporation, if it's a corporate bond, to a municipality or a local government. And you expect, if you're going to lend, that you're going to have your money returned to you, and you're going to have it returned plus interest. When it comes down to the interest rate that you would actually receive, that's going to depend on the level of risk that you're actually taking on. So this is the analogy I like to think of when I describe this to folks. Let's say that you have a friend that you have known for decades. This friend has their house organized, they are never late anywhere, they're always on time for everything. And this is someone that you see on a regular basis. If they asked you to lend them some money, it's very likely that you probably would. And you might not even charge interest if they're a really good friend. But let's say you do. You charge them 1%. Now, you just met this friend through work or as a friend of a friend who's a fun person. They're always worth a laugh. They're all over the place. Their life is chaotic. And you just met them last week and they asked to borrow some money from you. Now, if you're very kind-hearted, maybe you lend it to them anyways. But is it fair to say that you'd probably charge them a higher interest rate than the friend that you've known for decades? I would say that it probably is. It's the same general idea when you think about companies or even governments that you may lend money to through the purchasing of a bond. The idea is the more risky that is, the higher interest rate you're going to charge. The less risky that is, the lower interest rate you're going to charge. So it's considering how stable, how predictable, and what the likelihood of you getting your money back is from completing that loan that needs to be taken into account. The third item on our list are mutual funds or ETFs. These are both similar, but they are not the same. Mutual funds and ETFs are both a collection of stocks, bonds, alternatives. They can be managed in a myriad of different ways. You have some mutual funds or ETFs that are exceedingly aggressive and some that are very, very conservative. But there is, in some capacity, a third party or a portfolio manager that's at play in each of these. You're purchasing a piece or an all-encompassing portfolio. Some of these are set up to only hold large cap companies. Some of these have a full portfolio built into them. But effectively, it's an investment instrument that has a element of diversification built into it. And they are a great way to start out. Considering which type of mutual fund or ETF you should use is something you should absolutely take up with your financial advisor and consider the level of risk that you're willing to take on and really help understand what you're actually invested in. The fourth item is real estate or alternative investments. Now, there are a handful of ways to invest in real estate. We don't give advice on how to invest in private real estate, but that is something that many people will purchase rentals or will try and flip homes. That's theoretically one way to invest in real estate. You also have real estate investment trusts, which trade similar to mutual funds or ETFs, but not quite the same. You can purchase ETFs and mutual funds that have commodities like gold or precious metals in general in them as an example. Again, something that's a little bit different than what the traditional investment options are with especially your retirement plan. So this is something you should absolutely consult your advisor on prior to jumping in head first. Getting into the next section here, when beginning to invest, one of the key factors that you need to consider is what are you actually investing for? Step one there is really determining your capacity to handle a loss, which is otherwise referred to as risk tolerance. Oftentimes your time horizon or how long you're willing to stay invested has a big part to play in that. But the reality is, for most people, if you've never invested before, it's probably a good idea to start small to begin with. Now, small is relative, so that may mean $25 a month for someone. That may mean $1,000 every other week for someone else. But the reality is you need to determine, probably yourself along with your financial advisor, what is a responsible number to begin with. You can invest in several different types of accounts. There is the retirement umbrella. This could include things like your 401k or 403b through work. This could include a regular IRA or a Roth IRA. We'll get more into the details of those in future episodes, so I won't dive too deep today. You also have non-retirement investments that you can utilize. There are individual accounts. There are what are called TOD or transfer on death accounts. There are 529 accounts. There are UGMA or UTMA accounts. Again, we'll dive more into those in the future, but effectively speaking, these are all retirement accounts, all accounts that are not focused specifically on retirement. Now, if you've heard all of this and you thought, wow, this is fantastic, I'm getting a wonderful breakdown on where I should get started, I think it's a good idea to consider what the right first step would be. There are numerous ways to get invested, but I would strongly urge you, especially if you're just getting exposed to this information, seek financial guidance from an advisor that you trust. If you have questions for us and want us to expand further on anything, by all means, please feel free to reach out. But wherever you go, realistically getting advice from someone who's been down the road is going to be worthwhile to add to your decision-making process. Before we wrap up here today, we do have a brief question that was sent in. Today's question, which we're going to begin integrating into these episodes on a bi-weekly basis, is how often should I check my investments once I've started? So you've taken the first step, you've gotten invested, whether that's through your employer or on your own. The number one key, especially if you're investing for the long term, is you probably don't need to deal with all of the emotion that kind of gets riled up with the markets on a day-to-day basis. Now, I'm well aware I'm going to say this, and many people are checking multiple times a day, and that's okay. It's your prerogative. We as advisors check our clients' accounts on a daily basis. Personally, I do not look at my accounts every single day. I would say I normally check on a weekly or bi-weekly basis, especially because, again, I'm looking at the markets already, so I have kind of an idea how I'm allocated and what that should look like. The reason to check your accounts more frequently than monthly is to make sure that there's no fraud issues, admittedly. There's probably not a lot, especially if you're long-term focused from a retirement perspective. If you've done a good job making sure it's allocated properly and you're not too concentrated in any specific area, again, consult a financial advisor. That should help you avoid this problem. There's not the requirement for you to make a move every single time the market does. So focusing on being efficient with your time and understanding the emotional aspect that comes in with retirement savings specifically, but really any type of investing is important. To be a devil's advocate here a little bit, what I normally discuss with people is if you find that you're super charged up, if you see that the market's up, your emotions are high, or you're borderline depressed if the market's down, this is probably a sign that you should not be checking your account on a daily basis. If it doesn't impact you emotionally in any way, shape, or form, perhaps you're fine looking at it on a regular basis like that. But ultimately, this is where the behavioral side of finance really needs to come in. And this is another thing that advisors help clients understand is you need to understand what your triggers are, what may set those off, and is that a direction that you want to be headed. So hopefully that's helpful on the Q&A section here. Closing remarks here for us today. I want to say thank you for joining us on this episode of Invested in You, brought to you by Community First Investment Group, here for your now, here for your future. We hope you found this episode helpful. If you have any questions or want to talk with our team, you can visit us at cfigadvisors.com or check us out on Facebook, LinkedIn, or YouTube. We'll see you on our next episode, Savings versus Investing. The opinions voiced in this podcast are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a decision. Securities and advisory services are offered through LPL Financial, a registered investment advisor and broker-dealer, member FINRA SIPC. Insurance products are offered through LPL or its licensed affiliates. Community First Bank and Community First Investment Group are not registered as a broker-dealer or investment advisor. Registered representatives of LPL offer products and services using Community First Investment Group and may also be employees of Community First Bank. These products and services are being offered through LPL or its affiliates, which are separate entities from and not affiliates of Community First Bank or Community First Investment Group. There is no assurance that techniques and strategies discussed are suitable for all investors or will yield positive outcomes. The purchase of certain securities may be required to affect some of these strategies. Investments involve risk, include possible loss of principal.
Securities and insurance offered through LPL or its affiliates are not FDIC insured by FDIC or any other government agency, not bank guaranteed, not bank deposits or obligations, and may lose value.